Before we begin, here's how to earn continuing professional education credit for attending this session. Gain valuable insights by attending the podcast, then complete the assessment test to download your certificate. To do this, follow these simple steps. Click on the link in your description to access the session. Create a free account and attend the podcast. After the podcast, take the assessment test and download your certificate. It's easy, and it's free. We highly recommend checking out our subscription. Let's get started.
I know you also mentioned this in your framework, but with the pandemic and now everything being so much remote, we've got now so many tools out there. Does location still, like the geography, does it still keep an
Not,
impact?
not so much anymore. And whenever I have a conversation with a brick and mortar, really since COVID, it's like, well, how many clients do you actually see? Yeah, we still need an office. Yeah, maybe 10 a year come in out of like the couple hundred clients. So it's like they're weaning off of that.
Yeah.
It seems to be less important, but you got to be careful. A hybrid practice is different than a fully virtual practice. So
Yes.
some buyers feel like, okay, if I need to go to that office once a month to meet with clients for appointments, no problem. I'll fly in from across the country to do that.
Sure.
Others, know that over time they can begin to move it to a fully virtual location. So,
Yeah.
but make no mistake, the virtual practices, those that have already taken the steps to implement to become fully virtual, the level of interest on those practices, it just makes sense. You have a much wider variety of potential buyers where you can operate that firm from anywhere. And because there isn't the same level of overhead typically without rent, they're profitable.
True. Especially if they're like A-list clients, maybe, you got high relations, the client has been there for a long time and everything. If it's something that just needs to be done once in a while, probably that would have definitely worked. But yeah, you don't want to, but like I said, it depends on the buyer, like you always say, because there could be buyers who could really be looking for that,
Yeah.
So,
Yeah. And it's funny. I have conversations all the time with sellers that are a year, 2, 3 years away from selling. And what can I do now? What can I do now to make my firm more valuable? And
welcome back to another episode of Accounting M&A Insider. I'm your host, Saul. And if you ever thought about what your firm is worth, whether it's more than what the buyers are offering, well, you're going to want to stick around. Joining me again today is Todd Steinberg, the founder of Thrive Financial Group. If you missed our last conversation, we walked through how to prep your firm for sale. Today, we are digging deeper into what your CPA firm is actually worth, and maybe more importantly, why. Todd, good to have you back.
thank you for having me back. Part 2.
Part 2 it is. So let's set the tone for this one, right? I talk to a lot of firm owners who hear things like 3x revenue and assume that's the floor. And then, they get hit with reality during the due diligence phase. So there's like a lot of mystery around how these deals are priced. So I thought, who better to help decide this than you? So, let's just start from the top. How are the most accounting firms priced in today's market? What's the actual framework?
Yeah. Great question. So there's certainly been more change with regards to the answer here in the last 2 to 3 years than there was in my previous 27 years in the business.
Right.
So, stay tuned. By the time this is published, it could be changing furthermore. Here's what I'll start off by saying that there is a difference between small firms and what those firms are trading for and what large firms are trading for. And so
Right.
when I speak today, I'm speaking about what I think the bulk of your audience is likely, and that's 5 million and under in revenue. And I think that the valuation that I'll share and the metrics that I'll share would be applicable to the large majority of those firms.
Yes.
And anything 5 to 20 million is another range. And then when you start to get into much larger,
Yeah.
top 100 firms, the multiples can get even more substantial, which is why you see a lot of roll-ups in firms that are looking to consolidate to ultimately flip This is the private equity play that we're seeing often in the industry now. So I just wanted to preface it with that.
Yes.
What I would say for the small to mid-sized firms, again, that under 5 million in revenue, is that historically, firms were trading for anywhere between 1 times revenue to 1.5 times revenue. And there were 4 factors that, as a broker, we would use to determine the value of that practice. And these are in no particular order, but I'll touch on them briefly. This is historically the main components. Number 1 would be location, just like in real estate, location, location, location. One in a major metropolitan area is going to sell for more than one would in rural Iowa. So that's an important factor, just more densely population and higher concentration of potential buyers. I'd also add, in today's day and age, virtual versus non-virtual. Virtual firms certainly more attractive than physical office location. So that's number 1. Number 2 would be profitability. And profitability certainly is a factor, but and we may have touched on this a bit in our last episode, but I think it bears repeating that it really depends on the firm, in that you could have a $1 million firm here, firm A, that the owner works a lot of hours. They have a very lean team. They are basically a very highly profitable practice without getting into all the details, right? And then on the other hand, you have firm B, which is also $1 million firm, but that firm owner likes to take 9 weeks vacation per year. They work 25 hours a week. They've got a great team. They have Class A office. They've got, on and on and on. So you can see where I'm going with this, that you might have less profitability here, but who's to say one firm is more valuable than the other? It's my belief that beauty lies in the eye of the beholder. You may have one buyer who sees that first firm as the real natural choice. There might be somebody else who sees firm B as the ideal choice. So that really is subjective in my view. Number 3 would be client mix. So recurrence of revenues, more valuable than annual transactions or one-off consulting projects. So things like accounting, bookkeeping, payroll, advisory services tend to carry a higher multiple than consulting or tax preparation, as an example. And then lastly would be transition assistance, both from the staff, assuming that there is a team in place that could come along with the sale. Many firms are acquiring practices for not only the revenue, but also the human capital. So that's a factor. And in addition, whatever the seller's desired plan is post-sale, typically there's a real attractiveness to when that seller is willing to stay on for at least a year or maybe longer. So the longer they're willing to be involved versus riding off into the sunset typically has an impact on valuations as well. Because when you really stop and think about what are we selling, we're selling goodwill. So we got to make sure that that client base sticks around and comes back. So the best way to do that is to keep things as consistent as possible and make it feel more like a merger with the same team, same staff, same owner, so that we can have a smooth handoff. So all those things together, we're pegging firms between that 1 and 1.5 range. Now, I would be remiss if I said that that's solely how we value practices today, because there are certainly a lot of credibility and a lot of discussion around EBITDA, around SDE, and you hear anything from 3 to 5, 4, 4.5 times SDE or EBITDA. And in many cases, we're valuing firms that way as well for many of our clients, which could, if it's the right practice, translate to a 2 times multiple on top line. I've even seen 2.5. So anything above 2.5, typically the numbers don't really work, at least from a cash flow perspective on taking out a loan and debt service. So I'll pause there and saying that it's still, in my world, it's still predominantly a multiple of revenue, because profitability and SDE can be manipulated a bit. And it's more about what is the buyer's expenses versus the seller's expenses. So with that said, I feel very strongly that you want to look at all of those factors, and every firm is different and unique. But the bottom line here is that what was a 1 times revenue firm 3 years ago is now a 1.25 firm. What was a 1.25 firm is now a 1.5. So the valuations are going higher because people are realizing that this is a good business to be in.
Do you want to earn CPE credit? Take this course of MyCPE 1 to earn free credit. Click the link in the description to get started.
Wow, wow. Well, like the framework that you just pointed out, that is as practical as it can get for this, lower mid-market and these small firms that we are focusing on. And, I mean, like, just to clarify for all our listeners as well, valuation isn't always what someone's willing to pay, right? I mean, there's a spread between theoretical value and the real world market value.
Absolutely. The bank, if there's a finance company involved, has a lot to say with this too. It's got a cash flow, and these are cash flow lenders. So, the bank certainly has a lot to say with it. And who is your buyer? Is it somebody who's coming in and has an expense structure? They have to have an office. They have to get by software package. They've got a lot of expenses in addition to the debt service, or is it an existing platform that may already have an office in that area that really can absorb this without much expense outside maybe staff to run it, but they don't have the overhead that maybe a new buyer coming in would likely have. So it really depends on who your buyer is and how they're seeing it and what it might be worth to them.
Absolutely. And, in fact, I've had owners tell me that, when I have these discussions with them, it was very weird. Somebody said to me that my firm is worth 2 million because I heard that that's what someone else got.
Yeah.
But like when we dig in, it's a different story entirely. Why do you think the sellers are overestimating this so often?
Well, everybody thinks that they've got, phenomenal business. I sometimes I had to do a reality check. And the best way to do that is to just talk about recent examples of similar types of firms and kind of what's been happening in the marketplace. I'm all for getting top dollar in terms for my client when I work with a seller. I want them to feel good about the deal. But it's kind of finding that balance between the right fit, cultural, personality, level of service, and the economics. So if it's unrealistic, there's always outliers because they've got hyper profitable firm or they're virtual, they've got outstanding average fees, but every firm is going to be a little bit different. So people tend to value their own practice maybe more than the general public would because it's the way that they like it to be set up, but it might not be the way that the rest of the marketplace likes it to be set up. So, you have to be honest with yourself and do a comparison, not just with the way Thrive is selling firms, but just industry wide. And this is why talking to bankers and talking to attorneys that specialize in these types of transactions, talking to people like you who are dealing with all different types of firms all over the country that have probably worked with a ton of different brokers and saying, what's the pulse? What's going on out there right now? Because otherwise it's just going to sit on the marketplace and it'll never get sold.
Absolutely. And so, so let's get into what actually moves the dial, right? I mean, I know you already touched on the framework, but if I were to ask you, what are the big drivers that are driving valuation multiples? What would they be?
Yeah. So the big drivers these days is going to be number one, people want a sticky client base. So a firm that's been in existence that has a track record of either being consistent or growing with good steady clients, not a revolving door of special projects or new clients that just have been on board for a year or two. They want sticky because that means retention. So I think the client mix is a really important factor. And when I say client mix, that also means good clients, right? Not just people who are willing to pay, but people that generally value the combination of service for the price that they're paying, right? So everybody has some level of like A, B, C clients. So hopefully it's a good practice with good clients that really value what we do. And I think a lot of buyers are on the hunt for something like that.
Yeah.
Yeah, I think the second thing is how tech forward are they in today's day and age? How do they serve their clients? So, I just had a conversation with a woman earlier today. She still has 80% of her clients coming in to meet with her. Like they sit down, they have their taxes done. And that's okay for like a small percentage of people who just aren't adapting to technology, maybe some of the older client base. But if you're not moving to more of a remote virtual portal environment, needless to say, there's a lot of work that needs to be done to modernize that firm. So if that work's already been done, or a lot of that legwork's been done, then that's certainly going to be an attractive piece as well. Taking the steps to drive profitability, whether that's outsourcing to a third party, some of the basic compliance work, beginning to think about adding other service offerings to create other profit centers. These are probably a few other areas I would just note as well.
Well, interesting, and the things like you said, like the recurring revenue, which you said was one of the biggest drivers, especially, when you have higher realization rates. Do those also add like a premium to the pricing, the valuation?
They really do. It's funny because when I started my career back in 1994, what we were doing was teaching accountants how to sell a package of services for a fixed monthly fee to small business owners. And this was 30 years ago. Now, this was before Direct Draft, ACH, this was before QuickBooks, but it stayed the same. And that monthly or quarterly relationship, ideally monthly, where we provide them with a package or bundle of services for a fixed fee, value-based billing. And some of the services have changed from maybe what it was, a decade, 2 decades ago, as people were using their own software. But that type of client, it's not. I don't know a lot of CPAs that get excited in the morning and wake up and say, "Yeah, we're doing general ledger work today. This is awesome." But what I do know is that that type of work can be delegated, leveraged, outsourced, bookkeepers, staff accountants, so that the CPAs and tax professionals could focus on more higher value work, right? We hear that all the time in the industry now. So by having that basic blocking and tackling, that compliance, that monthly relationship, it just opens up a lot of doors for other services, and people like to get paid every month, and I don't blame them.
Yeah, absolutely. And you're right. I think what you did in long many years back, it also continues to be there. Maybe the way it is, the word for it has changed. We hear words floating around, client advisory services, or those are CAS is
Yes,
a word
yes.
floating around. But I mean that's the idea, to have that consistency, to have that recurring revenue.
Exactly. It was right up all many years ago, and CAS and advisory, but the model, the business model is the same. The offerings may change a bit.
Well, there you go. Who knew that, something that you had conceptualized many years ago was going to be one of the things that is driving firm multiples today, you know?
Absolutely.
Absolutely. Now, and this is this could be a debatable question, but does because a lot of CPA firms have got a niche, right? They focus on a particular industry, So does that seem to attract a different kind of buyer? Like, do you see firms in specialty verticals, like I don't know, dental, e-commerce, real estate? They're getting a different treatment.
Yeah. So that's a great question. So in my experience, niches are great because it does allow you to be that specialist that can look a client in the eye and say, "Look, I'm the firm. We're the group, or I'm the guy, or I'm the gal that specializes and understands your business." So to be able to go a mile deep and an inch wide, and not a mile wide and an inch deep, is, I think, valuable, and is a benefit and a selling factor, selling benefit to a prospective client. And once they're on board, I mean, you now have all these clients under that particular umbrella, and you can provide advice and guidance and planning that maybe some CPAs or tax professionals or business advisors just don't have, because they haven't dealt with it as much as you have. I think it's great. It can be more of a challenge if your firm is brick and mortar. And now, not only do we have to find somebody who wants to be in your town and maybe take over your space, but now also somebody has that level of expertise. So it does, unless you're a virtual firm, then I'd say great, because if we can market to the entire country, chances are there's a firm that's doing what you're doing or would like to do what you're doing, and we can find them. But when you start to layer on unique aspect after unique aspect, then it becomes a little bit more of a challenge in the marketplace. That could be overcome, however, if your fees are strong, because generally, in my experience, if you're a niche, then you can charge more for what you have in your head, as somebody who's a specialist versus a generalist. So if those fees are strong enough, then I think you can overcome that. Somebody might say, "You know what? That firm might be in Des Moines, Iowa, but I sure do like those average fees and that profitability. Let's relocate." So
Yeah. Absolutely, the dream come true for
With all due respect to Des Moines, Iowa, it's a nice little
yeah,
town. You know, it's
yes,
not the most. You get the point.
yeah, no,
You have to be able to sell that location as well.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now.
yeah, absolutely. I mean, but I know you also mentioned this in your framework, but with the pandemic and now everything being so much remote, we've got now so many tools out there. Does location still, like the geography, does it still keep an
Not
impact?
not so much anymore. And whenever I have a conversation with a brick and mortar, really since COVID, it's like, well, how many clients do you actually see? Yeah, we still need an office. Yeah, maybe 10 a year come in out of
Yeah,
like the couple hundred clients. So it's like they're weaning off of that,
yeah,
it seems to be less important, but you got to be careful. A hybrid practice is different than a fully virtual practice. So
yes,
some buyers feel like, okay, if I need to go to that office once a month to meet with clients for appointments, no problem. I'll fly in from across the country to do that.
sure,
Others, know that over time they can begin to move it to a fully virtual location. So,
yeah,
but make no
yeah.
mistake, the virtual practices, those that have already taken the steps to implement to become fully virtual, the level of interest on those practices, it just makes sense. You have a much wider variety of potential buyers where you can operate that firm from anywhere. And because there isn't the same level of overhead typically without rent, they're profitable.
True. I mean, like, yeah, especially if they're like A-list clients, maybe, you got high relations, the client has been them for a long time and everything. If it's something that just needs to be done once in a while, probably that would have definitely worked. But yeah, you don't want to, but like I said, it depends on the buyer, like you always say, because there could be buyers who could really be looking for that, you know. So,
Yeah. Yeah. And it's funny. I have conversations all the time with sellers that are a year, 2, 3 years away from selling. And what can I do now? What can I do now to make my firm more valuable? And while there are steps that you can take, one man's garbage or one woman's garbage is another man or woman's gold. So one person might see the way you're doing things ideal and love that. Others might not. So don't get so caught up in making these wholesale changes to your business model, because there is definitely going to be a buyer out there, being that it's such a seller's market and it's always been this way since I've been selling accounting firms for north of 20 years. That it might take going through a couple of prospective buyers, but there's somebody out there that's going to want to do what you're doing and how you're doing it as a seller. So yeah, there's steps you can take, but don't feel like you have to change around your business model just to try to milk a little bit more of a multiple or sales price.
there you go. Words of wisdom, Todd. You don't hear that often, but thank you for sharing that. So now this is the part which usually loses people. A term that I'm gonna be saying, which very few people must have heard of. It's called adjusted EBITDA, right? And you have heard it. I'm sure you must have had your conversations with sellers about it. So how do you walk sellers through calculating the adjusted EBITDA?
Yeah, look, it's definitely a good measurement tool when the transition has occurred, and we can look at those adjusted EBITDA numbers. As again, somebody who typically works with the sellers, while I know buyers are focused on EBITDA, SDE, ultimately we have to do a pro forma and a projection and take a look at what that is going to look like once the sale's been consummated. So, I try not to get lost in all these mathematical equations that are, of course, important to valuation and deal structure. But what I really try to focus on, to be very transparent, is its fit. And while ultimately it's got a cash flow, it's got to make sense. Adjusted EBITDA is certainly a measurement tool that we look at. I think most buyers and sellers would tell you that if they found the right firm and the right people and the right individuals, and it's just the right fit, then they can look past maybe a smaller adjusted EBITDA percentage or number than if it weren't the right fit, but they had a better margin or adjusted EBITDA. So there's a lot of stars that need to line up in order for it to be the right deal. And that's certainly one of them. Don't get me wrong. But I do think that sometimes we get, as a broker and as a buyer and seller, we get very lost in some of those figures and kind of lose sight of, well, even if the margin's great, like, I don't know, they don't do things the way that I do or the way I'd want to. And well, maybe this isn't the right firm for you, regardless of what these numbers are. So I just say take a look at the big picture, and it's not easy to find a firm that aligns with everything that needs to fall into place in order for it to be a good deal for everybody.
No, absolutely. I mean, because when we talk about EBITDA, everybody's all right. So this is what the company business is going to be making if it already did not have any tax or debt obligations and everything. Good,
Yeah.
benchmark for cash flow and how much is it making and everything. But adjusted EBITDA, like you rightly pointed out, how it's going to be after the sale has happened, because a lot of things get into it, right? If the owner is drawing a salary and there are add backs to it, and there's so many things that go into it to get to that adjusted EBITDA. And if the owner has been investing too many hours, and if he's going to be exiting out, then the replacement of that, you know.
Yeah. And look, I just want to reiterate that here at Thrive, these are important metrics. EBITDA, SDE, adjusted EBITDA. We take all those things in consideration from a valuation perspective, whether it meets the debt service to get a loan. I can't put together a deal unless I know the bank's going to approve it, right? So we've got to run cash flow projections and do some pro formas and make sure everything's going to iron out, or otherwise it's just not a good deal for everybody. So everyone's coming to the table with a different starting point as a buyer. So sometimes it makes perfect sense for one buyer group, the same firm, and for another buyer group, it doesn't make sense at all. So it's just trying to find that right fit.
Yeah, but I mean, like, let's just talk about normalization, right? Not to get too much technical, but just normalize. What's a reasonable add back? What is it that people get it wrong?
Yeah, I mean, without getting too technical, of course, sellers are going to try to maximize the deductions. I mean, we see quite a bit of add backs. This does become a little problematic in some cases, but in terms of normalization, it's really all over the board. I can't say that I have like a finite percentage or number of what is typical for these small to mid-sized firms. I mean, we have some people that they're showing that they're losing money, and you do all the ad backs and they're making $300,000-$400,000 a year. Right? In other cases, it's not much at all. So creative accounting, I guess, in some cases, but it's certainly a factor, and most buyers and lenders, for that matter, can kind of look at that and say, what's reasonable and what's not reasonable.
Have you ever had a seller that totally missed the mark on what they thought was add back eligible?
Oh, absolutely. Yeah, it's happened. I mean, not as much as it hasn't happened often, thankfully, but it does happen. Yeah.
Yeah, yeah. I mean, like, I've had one. I mean, I have had one seller that had to include the dog grooming bills.
Yeah.
And I'm like, I mean, respect, but
Yeah.
you know.
Yeah,
All
you
right.
got to
So,
be careful. It's like, is that the best thing to do when you're preparing your practice for sale? Probably not, right?
yeah,
So
absolutely.
if you're a
All
couple
right.
years away, make sure you're running it clean and it's simple and straightforward. Same thing with the way you prepare your tax returns, because ultimately, we're gonna need those. If you
Yeah.
expect a borrower to be able to go get a loan, especially for these types of businesses, when you're buying goodwill, there's not really a lot of collateral. There's not really real estate in some cases. There is, but in most there's not. So it's got to be a really strong deal financially. So if your financials or tax returns are and you can justify it in some ways, but if it's not going to stand up to an underwriter, we're gonna have a
True.
problem.
True. 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 So let's talk about the market movement. Because private equity has been there, and off late, there's a lot of buzz on private equity. But
Mhm.
how is private equity influencing the price landscape for firms in the lower middle market right now?
Yeah. So, what started as a few years ago was they were going after the big firms, and they had a few wins there, and it's really trickled down now into mid-sized firms and even these smaller firms. they're typically not looking at anything, at least in my experience, that's been under like 750,000. Ideally, a few $1 million in revenue. If they already have an office location, maybe they'll tuck something in that's a little bit smaller. So what it's doing to valuations, in my experience, is what used to be in certain instances, there would be a long seller note or a percentage of a deal that would be what was, I guess, still called an earnout, right? Like a percentage of collections over a period of time. Well, who in their right mind would sell their practice for a percentage of collections when you've got private equity over here that's willing to hand you a check for, let's just call it 60% of your firm's value. And then you've got this large private equity group that is financially sound versus a personal guarantee from an individual buyer who, that might be worthless. So it's up the ante in terms of the terms and what people can expect. So more cash at close. And I think more in the way of guarantees that promissory note will be paid. And earnouts seem to be now, not just for smaller firms, but for the bigger firms, kind of a thing of the past.
True. I guess earnout was a retention strategy. It's just a way to make sure there's whatever was on the paper and whatever was as the business was continues to remain as is. That's why they would try to retain it. But you're true. That's absolutely true. It is definitely changing. And now, I want to move to the most favorite part of this podcast, strategy. All right. So what can a seller actually do in the next 12 to 24 months to bump up their value?
Well, like I said earlier, I don't like people getting so caught up in making dramatic changes and performing radical surgery to their practice in order to maximize value. Look, it goes without saying that if your business is more profitable, it's going to be more attractive, right? I mean, so to the extent that you can pull a few levers there, without that impacting your work-life balance as a business owner, it doesn't mean you got to work more hours and cut your staff in half. Like that's not what we're talking about. But if you can rely on a third party, like an outsourcing organization, to do some of the basic compliance, you can begin to think about cross-selling other services. That's not a dirty word, but what other ancillary services can I begin to offer, not only to make that relationship with my client stickier and offer more in an ever-changing marketplace, but now I've got more revenue. I mean, you can either grow by getting more clients, or you can grow by selling more services to your existing clients. And I think that makes a lot of sense, where clients today can get things in a one-step nature. And that might even mean having strategic partnerships with other organizations that pay you a piece. We do that within our own business. So I'm sure there are many firms out there that do that, whether it's with wealth advisors or other. ADP shares a percentage of the fees. So there's ways to do that that can increase your revenue and ultimately your profitability without adding any cost, expense, or risk to your firm.
Absolutely. Well, Todd, this has been gold. Now, before we wrap up, for anyone who is listening, who wants to connect with you, learn more about Thrive, or just to get a handle of the firm's value, where should they go?
Yeah, so the best place to go would be my website. All our contact information is there. They can visit us online at thrivefinancialgrp.com.
All right. Well, I will be having this website mentioned in the notes and descriptions as well. So you will have a handy, it will be handy for you. And with that, Todd, we come to the wrap to the second episode of this brilliant podcast that I've had with you. So thank you so much, Todd, for your time.
Thank you, Saul. This was fun doing number 2. And I don't know, maybe we'll have to do number 3 at some point. So
yeah, absolutely. I'm already starting to think about that framework.
Always things to talk about. So, we're just scratching the surface. So, well, good stuff. Again, I appreciate you having me, and thank you to your listeners, and hopefully that we provided some unique lens here to what is oftentimes a confusing scenario in the M&A space in today's market. So thank you again.
Absolutely. All right. And to all our listeners, stay tuned. More episodes coming soon on the messy, fascinating, and high-stakes world of accounting firm M&A. Until next time, take care And as always, keep innovating in everything that you do. Cheers.
Access latest and trending CPE courses with my CPE One Unlimited Access subscription. Subscribe now